Hello and welcome back once again for video number 6 of our Investing Fundamentals series and course. And previously we talked about EPS, earnings per share, and we calculated it for NVIDIA for the last 12 months. And it was $3.28, meaning that for each share that you own, you are basically getting back $3.28 of earnings per share. So, today and in this video, we're going to be talking about the PE ratio, the well-known PE ratio that all of you have heard about. And we will calculate it for the last 12 months for NVIDIA. And what is price to earnings ratio? So price to earnings ratio is basically a ratio that tries to correlate the current price of the company, of the stock, to the earnings of the company. Because if you correlate the price of the stock to the earnings of the company, you can find how much you are paying when you compare it to how much the company is making. And so this is a sense of how overvalued or undervalued your investment is, because you obviously want a lower multiple. You want to be getting more out of your money and not less. And so right now, NVIDIA is sitting at 286, 287 almost dollars. And the price to the APS we calculated earlier was $3.28. So what we want to do to calculate the PE ratio is we want to get the price of the stock, PE ratio, right, price to earnings, and divide it to the earnings per share. Because remember, the price of the stock is the price per share, and the earnings is as a total, the 8.2 billion is the earnings for every share. But we want the earnings per share because we're calculating the price per share. So EPS is basically earnings per share. It's actually the correct way to say it is price per share divided by earnings per share, because everything is calculated per share. And you could use the market cap, but since we have the earnings per share here, and I think it's a little bit easier to calculate and understand what the concept is, we will just use that. So it's 3.28. So what we're gonna do is get the price per share and divide it by earnings per share, and we do 287 divided by 328. So 287 divided by 328. And that gives us a PE ratio, a current 12-month PE ratio of 87.5. And now, is that overvalued? This probably is overvalued, more than likely. But overvalued is a little bit relative, and it has to do with the other stocks in the industry as well. And there are many more things to calculate, but typically we want to see a PE ratio that's about 15 to 20, if possible. More than that tends to lead to overpriced shares, stocks. And right now you will see that the forward PE is expected to be 57, so for the next 12 months. And that's what the forward PE is. So the current PE that we examined is the 12-month PE, the previous 12 months PE, and the forward PE is the next 12 months PE. That's the difference. And so hopefully that helps you understand what the price to earnings ratio is and how to calculate it, and can help you make better decisions and see whether you are paying too much for a company. And again, I want to make sure that you are able to calculate this without having to consult your handbook or so. Simple things. Hopefully that was useful to you, and if you did enjoy it, please remember to leave a like, that would help. And also subscribe, and I'll see you in the next video, where we're going to be talking about more financial aspects and key ratios that we want to understand before making an investment decision. Thank you for watching. See you soon. Bye.